prediction is like a muscle. So if you're using it consistently, you're going to get better at it.
I am very pleased to welcome everyone back to Breaking Bread, our second podcast episode, where we're developing financial insights and providing insights that help business owners, particularly small business owners, to be more strategic and more thoughtful in their business development. I'm Noah Simons, the co-founder and CEO of GoodBread Capital Partners, where we are making small business loans and small business capital more accessible to Main Street business owners who could use small dollar loans to help grow their businesses. I am pleased to welcome Sarah back for a second round, and we decided to have back-to-back guest appearances by the same person so that people who wanted to join us live to have a conversation with Sarah and myself would get a chance to know her a little bit through our first episode. I'm very excited to introduce Sarah. She is a good friend of mine. She's also a very experienced strategic financial professional. So she's been a fractional CFO for professional services firms for almost 2 decades, I would say. She's had a long career working as a financial analyst and as an asset manager prior to going off on her own. So she's an entrepreneur in her own right, owning her own financial practice. And Sarah, maybe before we get into the nuts and bolts, maybe you'd like to just say a couple words about your own entrepreneurial journey and how that's going.
Yeah, sure. As Noah said, in my 20s, I was a financial analyst, worked for Fidelity Investments. I was an asset manager for a private equity firm. So I was very much the corporate climber, and learned a lot about kind of how finance works at big companies and like what are best practices. And then I essentially got to the age of 30 and realized that the corporate environment was not the right place for me, because I felt like I had to sort of put on my armor every day and like talk a certain way and act a certain way that just didn't feel authentic for me. So I essentially jumped off the corporate cliff, and I decided to travel and dance tango for about a year and a half and follow my bliss, and didn't know what the heck I was going to do with my career when I came back from it. But ultimately, when I settled where I am now in the Hudson Valley, I looked around and saw a lot of small businesses that needed financial, like some really good financial guidance and like skills that they just didn't have, because they were entrepreneurs and they had a good idea and they kind of grew it on their gut. And so they needed someone to kind of help professionalize them and to provide those insights, strategy, analysis. So I thought to myself, well, I actually kind of love finance and numbers and business. So why don't I just do this for local businesses? And so I kind of started out not really calling myself either a CFO or a fractional CFO, because that term didn't even exist in 2011. But I was like, I'm a freelance finance person. Who needs me? And sure enough, local businesses did need me. And so that was the beginning in 2011 of a 15-year, journey as a fractional CFO, kind of over time, working with larger and larger businesses. I've worked with different types, but mostly agencies, consulting firms, the professional services type business model.
Right.
And so it's been amazing. And I have this sort of ethos that like, I only work with clients that I would hang out with, and that has served me well. And my mission is do good work with good people and have an impact. So that's what matters to me.
Yeah, awesome. Well, I'm so glad you decided to do that and bring your expertise to many people that I know, and myself included, from time to time over the years. So I think great to have you here today. I want to pause just for a minute before we get into it and just let everybody take a minute to think about yourself. Do you feel confident in your financial habits? And do you think there's more that you could do? And I suspect that, many of us are in the, always be learning ABL kind of category of people who are into growth about our knowledge and our experience. And so I'm hoping that this can help, today's program can help catalyze some insights for the people who listen. Point number one, working with a CPA quarterly. I'd love for you to maybe tackle the question, what's a lot of us maybe have thought or perhaps still do only talk to our CPA once a year. And so I'd love for you to talk about what's the downside to that.
So first of all, I want to just say I'm not a CPA, so this is not a plug for you to like talk to me or something. And in fact, I always, when I first talk to a new client, I say, I want you to have a good CPA because I don't do taxes and I need somebody covering that base really well. And so that allows me to partner with the business owner and the CPA to make sure that like all the bases are covered, right? Some pitfalls of only meeting with your CPA once a year are that you're not taking advantage of opportunities to minimize taxes, because that's obviously the name of the game, right? You want to stay legal and you want to minimize your tax liability. So every quarter, you want to be meeting to talk about your estimated tax payments. So rather than just say, oh, I've got my quarterly estimates prepared based on prior year financial performance, I'm just going to write that check. That may not be the right number because you may be, have profit may be up, profit may be down. So you want to have your CPA re-estimate those quarterly tax payments because at the end of the year, the goal, if you've done it all right, is to not owe and to not get a refund. Right. So like you really want to be like, trying to get as accurate as you can on a quarterly basis. You want to talk quarterly on any big purchases or planned investments. You want to talk to your CPA in advance of doing that because there can be strategies around, any kind of, investments, purchases, equipments, property. You want to understand that every single thing that you do is going to have a tax impact. You want to know about that ahead of time because rather than going on like the assumption that, oh, anything I spend money on is a write-off or any kind of loan interest expense is a write-off, that's not necessarily true. And timing matters. So whether you do it now versus wait or timing during the year, like all of those things really need consultation from a tax professional.
Yeah.
And also like any hiring or payroll changes, you want to have that conversation about contractor versus W-2. You want to stay in compliance. There may be tax law updates that impact you and your business. If you're an S Corp, you want to adjust the shareholder salaries to remain kind of stay in that reasonable compensation range. So those are sort of like a quarterly cadence of conversation. And then there can be additional meetings for major events. So like some obvious ones, if you add or remove owners, right? Or if you take on investors, or if you think of selling a company, but also, and certain kinds of debt, different debt works differently. Making a major asset purchase. Or if you experience a sharp change in revenue, like don't wait till the quarter's over. Let's, talk to your CPA about it. And you just want to be proactive because timing matters in all of this. And you want to make sure like if there's an opportunity to, do something different with how you're funding your retirement plans or what you're doing with bonuses, things like that. You just want to get ahead of all of it and not make assumptions that like, oh, it's all going to come out in the wash of the tax return. There are things you may need to be doing, early and often to minimize the tax liability.
Yeah, I think two things come to mind. One is proactivity, just over generally being proactive and committing to the time and the energy that it requires to be proactive, particularly for people who are working in their business every day. It's a real commitment and it's a real discipline. And so when we talk about a habit, we're trying to make something routine that you don't have to sort of think about and muster so much energy for because it's routine and it's something you do every day, like brushing your teeth. or something you do every quarter because it's on your calendar and that's where it shows up. And so developing that discipline for proactivity, I think, is thematic, both here and in other ways that people can be more strategic about growing their business. The other comment that I wanted to make here is on just making major asset purchase, for example, is that just the question of, and this is more granular, in some cases, it might make more sense to lease a piece of equipment rather than to buy it because of how that is reflected between the P&L statement that we talked about on our first episode and the balance sheet. So I wonder if you have 30 seconds on that before, or 30 seconds of comment you want to make before we move to the next topic.
Yeah, 100%. That lease versus buy conversation is definitely one that, your CPA is going to be able to do that analysis with you. Sometimes people get to the end of the year and they're like, oh, shoot, we had way more profit. And maybe there was a spike in Q4 or something. And so they go out and buy a car. And they're like, okay, I'm going to buy a $50,000 car and that's going to go on the business. Well, actually, only a piece of that car is going to get that depreciation is actually going to be deductible. So that whole 50,000 isn't going to come off your tax bill this year. So that type of thing, is something that you don't make assumptions, and also there's some complexities around having a car in the business. And I know some tax professionals that say that's a big red flag. So, there's a lot to know, and there's a reason these people have licenses. They're rely on them, use them, have this be a relationship that's not something where you're afraid to call them and run up a bill. You want that package with them to include ongoing conversations.
Yeah, I think that's a terrific point. We spent some time describing what these things are in our last in our first program, but I'd love for you to talk a little bit more, again, just I think hammering home this point about what is an effective budget. How do you make a cash flow forecast be an effective live decision-making tool that you're interacting with and not just, creating and forgetting about?
Right. So this is my favorite topic. I love budgeting and I love this time of year because this is budgeting time of year for most companies.
Yeah.
So, and by the way, I'll just say, my professional experience spans huge, large companies and very, very small companies. And best practices, never had a job at a big company where we didn't do an annual budget. So that is bread and butter needs to happen. And I've seen small businesses not want to use a budget as a tool because they think that there is this becomes this mindset of, well, if it's in the budget, then we're going to spend it. That it's sort of creates this open, carte blanche to spend up until the amount that's budgeted in a particular line item or department. And that's not the right strategy. So to me, the best thing about a budget is that it's a time every year to sit down and look at the entire business and all of the different factors that combine to create a financial picture. And so it's a time to sit down and think about where you are. Usually it's this time of year, September, October. What have we done this year? How did it meet or exceed or be below our expectations for the year? How do we think we're going to land this year? Now, how are we going to build on that for next year? And what do we want to accomplish next year as a company? So it then creates this conversation around a bigger picture strategy for the business. Well, what does that look like? And how do you make a financial roadmap or a budget that matches that business strategy? And the budgeting process is iterative. So it's going to have they call it, there's two methods for creating a budget, top down and bottom up. So top down is this is how much we think we're going to do in revenue, or this is how much we want to do in revenue. And so then what does it take to actually generate that? What staff do we need? What sales, what marketing do we need to invest in to make that revenue happen? So you're starting at the top and then you're working your way down through the expenses to create the budget. And then the other method is bottom up, which is, what expenses do we have in the shop? Who do we want to hire? How do we want to, grow, or how do we want to change the expense structure based on what, different factors, like what do we need to invest in? We have to do a new website this year. We have to do, certain things in order to stay ahead. We have to invest in AI and how to, integrate AI into our business model. Okay, we can't not do that. What do we need in order to build into the budget to accomplish those things? Okay, well, that's this much expense. Now, how much revenue do we need in order to make our profit target?
Right.
So whichever way you do it, and I, usually like to kind of do both approaches.
Mhm.
It becomes an iterative process, because regardless of the method, it's going to generate, a certain kind of profit, and then you're going to go, oh, well, that's upside down. That's an unprofitable business the way this. So then what are the things that have to shift in order to make our profit target? And so that kind of big picture thinking, and also bringing key stakeholders, whether it's investors or the leadership team of the company, everyone has to kind of come together and get onto the same page to kind of go through this process. And then, that is, a really good level setting for everyone around. These are the goals for next year. Let's all be behind this, so we're not all kind of chasing different things and different initiatives.
Yep. Makes sense. Hopefully not as big a problem for very small business owners, probably, depending on their business. So maybe they can cut out that part, but they still need the budget, the planning, the intention that goes into all of that, right?
The intention, yes. It's like a mindfulness practice for the business, I think.
Mm-hmm.
Yeah.
It's an interesting analogy. Do you want to spend 30 seconds on cash flow?
Yeah. So a budget and cash flow are different, because depending on how you're funding the expenses, you could be applying debt. You could be bringing in certain loan instruments into place. You could decide to bring in investors. And so that may create an infusion of cash there. And also, of course, there's tax payments that have to be considered. So as you look at profit and cash are not the same, and you have to consider setting aside funds for tax payments, and not just assume like all of that is going to go into your pocket at the end of the year. So yes, a cash flow forecast. And also, like, there's the obvious things like, what revenue is one thing, cash is another. Like when you bill your clients on a certain cadence, then you have to look at like, well, what are the payment terms with clients or customers, and when is that cash actually going to hit? Obviously, when you've got a manufacturing business and a product type business, that timing can be very different.
Yeah.
And if you don't,
same with services business. A lot of people that we're seeing coming through our GoodBread, funnel are people who have, they're installing floors as subcontractors on construction projects, for example. And when those installations are done, they have to pay the people who have done that work every day, every week, every couple of weeks. But they may be not getting the money from the general contractor or from the person whose project they're doing for 30, 60, 90 days. And so this is actually a good use case for small dollar loans for people who are building these kinds of businesses from GoodBread. So it's I think that forecasting, that anticipation, that proactivity, I think is super important. The next thing that I think is important to talk about is pipeline. Measuring your pipeline, and what does that actually mean, and how does that tie to some of the earlier, especially the last thing we were just talking about with cash flow forecast?
Yeah, so the most, I think it's just as we were talking about being proactive with talking to your CPA, it's also just important to be proactive about your overall financial forecasting. So I personally love to do a 12-month rolling reforecast. So it's not just enough to do a budget and then put it on a shelf, and then if you're kind of the next level up, it's like you're reporting against it every month and looking at the variances and stuff. But then the real best practice is to use that as a launch point to create a rolling 12-month reforecast of what the business is expected to do. But what that requires is an ability to predict. Now, prediction is like a muscle. So if you're using it consistently, you're going to get better at it.
Mhm.
And one of the ways to predict accurately is to measure your pipeline and anything around how the revenue is flowing into the business. Because it's one thing to have a revenue forecast, but the pipeline is pre-revenue, and it's going to show you whether or not that revenue forecast is realistic. So what I think is great is to create a habit of measuring your pipeline over time. And what I like to do is even chart it on like a graph where you're creating some kind of estimates around, okay, here are the different opportunities, here are the opportunity values. And sometimes you're kind of throwing a little bit of a dart because you don't always know what the opportunity value is earlier in the process. But as an opportunity moves down the funnel, you should be able to get better at measuring the deal value. And then I like to do like a discount factor on each stage of the pipeline. So if it's so I like to think of the pipeline broadly. Everybody uses their own terms like interest confirmed, then you've got proposal requested, proposal delivered, verbal agreement, signed contract. At every step of the way, I shouldn't say that, not at every step can assign a dollar value. Interest, just an interest, probably not. But once you're down to a requested proposal, you're doing a needs assessment of a fairly good idea of a range of this dollar value of this opportunity. So for that proposal requested stage, you might assign a 50% discount on those opportunities. But then when it moves to proposal delivered, okay, maybe you'll put a 60%. And then when you get to verbal agreement, well, don't put 100%. Don't assume that's a done deal. Maybe it's a 95%. So as you're discounting those different deal values, you then create a total pipeline value as of a moment in time, and then plot it on a chart. And I like to do that like every 2 weeks, because depending on the business and how fast, things move, but I like to plot it on a chart and see how big is my pipeline. And then I plot sales on that same chart to see what does the pipeline look like in advance of sales and how does it flow? Because when the pipeline dips, hopefully it's because sales just jumped. You just converted that into revenue, but not always. Sometimes you lose deals and then the pipeline dips and the sales aren't there. So creating kind of a quota of cadence of how much revenue should come in by when, and seeing how that pipeline value relates to the sales and when that hits, I feel, and the visuals I think are really nice, is super important, because that all gives you data, insight, foresight into what's going to happen with revenue.
Yeah, I think a super important point that you made is that you're not likely to be good at it when you start. And so
Right.
This is also accepting. It's like for me with bowling, like I don't like going bowling because I'm not good at it.
Right.
But if I keep at it, sure enough, like and I do this every now and again just to continue trying to grow a skill that I don't have. So
Yeah.
it's sometimes hard to be comfortable, or it's hard to be okay with being uncomfortable in those kinds of areas. But I'm just highlighting that as something to maybe like not try to shy away from here. Regular rhythms for reviewing financials. So again, like I think easy to shy away from because there's a lot of numbers and sometimes math feels scary and sometimes money feels scary. So how did people help overcome some of these sort of, I would say, a psychological resistance to building a habit around this? What's important for them to think, for people to think about?
Yeah, for sure. And the most important thing is don't hide from it. And I see that, like, that's a recipe for disaster. So like you got to face the reality. And even if I always feel like, even if what you see doesn't look good or it really looks bad or alarming, but now you're empowered to do something and to know, like, that clarity is empowering. So the most important thing is to like have a relationship with your financials and, create rituals around certain things that you need to look at on a certain frequency. So depending on, no, this is like, I'm generalities are tough, but I'll try to speak in some generalities. So like I would think weekly or bi-weekly. I like looking at the pipeline, especially if it's kind of a fast moving, things are coming and going. Cash flow, I think, is really good to keep a close eye on. And like there's certain rules of thumb around how much cash you should have in the business at any given time. So you should kind of have your number in mind, 2, 3, 6 months of operating expenses, and always be looking at, okay, how are we against that? Accounts receivable outstanding. Don't let accounts receivable get old. That's an easy one. That's low hanging fruit. Get those collections going. Get a really good process around that. AP outstanding. So outstanding bills. Always be kind of on the pulse of what you owe and to whom and what's the timing. And there's strategies around like, oh, you should push your AP and pay it as late as possible. Well, you also have to consider vendor relationships and things like that. So, you should have a pulse on the AP. And then depending on the type of business, like if, the types of businesses that I support where there's, client work, you want to look at your project burn rates and how projects are burning versus budget and making sure you're staying way ahead of capturing scope and staying on scope.
I definitely had to deal with that a lot in when I was managing events with Upstate Capital, because it's very easy to blow through budgets.
Yes, exactly.
So, I completely understand that. Why is the owner's mindset just as important as the numbers, and maybe even more important? Because can you get to proactive empowerment if you don't change your mindset, right?
So I'm going to give you an example. I worked with a client who, when she talked to me, she said, I don't know. I just have this block with numbers. I don't know what it is. It just feels so impermeable to me and it makes me scared. And so I just don't know. I don't really know. So I started to look at her numbers and I started to see a few things very quickly. One is there were 2 months of double counted revenue because the bookkeeper was messing up. And she wasn't looking at her P&L, so she didn't even know that. Second of all, once you stripped out that, the business is actually unprofitable, and it doesn't look like it because she's drawing on a line of credit to pay herself and racking up more and more credit card debt. So when you put all these pieces together, it's like, your business is going into the ground, and it only doesn't feel like that because you're still paying yourself through these debt instruments. Now, you might be listening to this story and going, that's crazy. How can you just, not know that your business is unprofitable? But she just kept feeling like, oh, it's going to, the revenue is going to come in. It's a timing issue, this or that. And it was, so her feeling of like, I'm just blocked about it was causing her to go into like an untenable, just accruing debt and having an unprofitable business that needed some love and some shifts and some things to happen in order to kind of turn the whole situation around. So I think that like you gotta look, you gotta
right. How can you take those steps if you don't know they're there?
Exactly.
This has been great. I thank you so much for talking through some of the details of this. I feel like we could have many more of these conversations and go a lot deeper. But I think we're going to wrap up here. Is there any sort of last words of wisdom you want to share with people listening?
Yeah, I think with the mindset thing, I just want to also say that I really think that people's language speaks volumes about how they see their business. So when they talk about certain costs, if they talk about it as an expense versus an investment, they're looking at their business through two different lenses. So if it's just like, oh, this is more expensive, how are we going to be able to afford this? We can't afford this. Whenever I hear language like that, I'm like, ooh, this is not someone who's thinking in that kind of, big picture, or like, how is this business going to like thrive? But people who think of things in terms of this is an investment, then I see them as being the ones who can really be successful because they're looking at everything on an ROI basis versus this is dragging my bottom line down.
That's right. That return on investment is key. And I think if I had to summarize sort of what I want people to take away from this in 3 words, it's that clarity is empowering.
Oh, I love that.